Receiving a $6 million investment from someone in South Africa involves a complex process governed by strict foreign exchange controls and legal regulations. The South African Reserve Bank, SARB, oversees all capital flowing in and out of the country. Here's a breakdown of the key steps and considerations. The South African side, transferring the funds. Foreign exchange controls. South Africa has strict foreign exchange controls. The SARB, through authorized dealers, usually major banks, must approve all international money transfers. Allowances and approval. South African residents have certain annual allowances for transferring funds abroad. The standard is a R1 million single discretionary allowance and a R10 million foreign investment allowance. Special approval for large sums. A $6 million investment is a significant amount and would exceed these standard allowances. The investor in South Africa would need to apply to the Financial Surveillance Department of the SARB for special approval. This process requires a detailed application that includes a printed tax compliance status (TCS) verification result from the South African Revenue Service (SARS), documentation of the source of the funds, a motivational letter explaining the purpose of the transfer, working with an authorized dealer. The South African investor must work with an authorized dealer, a bank or a specialized forex broker, to facilitate the transfer. This dealer will assist with the application process and ensure compliance with all regulations. The U.S. side receiving the funds. Wire transfer. The funds will likely be received in the United States via a wire transfer to your bank account. Legal documentation. Your U.S. bank will require documentation to verify the source of the funds to comply with anti-money laundering regulations. This could include a copy of the investment agreement, details about the South African investor and the purpose of the funds. Tax implications. In the U.S., you will need to consider the tax implications of receiving a foreign investment. Investment, not income. If the money is a genuine investment, e.g., in exchange for equity in a company, it is generally not considered taxable income at the time of receipt. Reporting requirements. U.S. law, including the Bank Secrecy Act and the Foreign Account Tax Compliance Act, FATCA, requires reporting of foreign financial transactions. You may need to file specific forms with the IRS, such as Form 5471 or Form 8621, depending on the nature of the investment and the structure of the entities involved. Consult a tax professional. The tax rules for foreign investments are complex. It is highly recommended that you consult with a qualified tax advisor or CPA who specializes in international tax matters to ensure you are compliant and to plan for any future tax liabilities. Key takeaways. Complexity. This is not a simple bank transfer. The process is complex and requires careful adherence to both South African and U.S. regulations. Professional guidance. Both the South African investor and you should engage with financial and legal professionals who are experienced in international transactions. This includes an authorized dealer in South Africa and a tax advisor in the U.S. Documentation. Maintain meticulous records of all communications, applications, and approvals related to the investment. This documentation will be crucial for both the transfer process and for future tax reporting.